Hi, and welcome to Accounting with Professor Lamptey. In our last lesson, we answered a basic but essential question: what is accounting? We learned that accounting is the language of business. It helps us identify, measure, record, summarize, and communicate financial information so people can make better decisions. Today, we are building directly on that foundation by looking at one of the most important ideas in accounting, the accounting equation. Here it is. Assets equals liabilities plus equity. At first, this may look like a simple formula, but do not let its simplicity fool you. This equation explains the financial position of every business. It tells us what a business owns, what a business owes, and what belongs to the owner. If you understand the logic behind this equation, many future accounting topics will become much easier to learn. So today, we are not just going to memorize the equation, we are going to understand the story behind it. Let's begin. The accounting equation has three main parts: assets, liabilities, and equity. Let's break them down one by one using simple business language. First, assets. Assets are resources owned or controlled by a business that are expected to provide future benefit. In plain language, assets are what the business owns or controls to help it operate and make money. Examples include cash, inventory, equipment, buildings, vehicles, supplies, and money customers owe the business. That last one is important. If a customer buys goods or services on credit and promises to pay later, the business has a right to collect that money. That right is called accounts receivable, and accounts receivable is an asset. So if Amma's bakery owns an oven, that oven is an asset. If the bakery has cash in the bank, that cash is an asset. If customers owe the bakery money, that amount is also an asset. Now let's look at liabilities. Liabilities are obligations the business owes to others. In plain language, liabilities are what the business owes. Examples include bank loans, unpaid bills, wages owed, taxes owed, and amounts owed to suppliers. If Amma borrows money from a bank to buy bakery equipment, that loan is a liability. If the bakery receives a utility bill but has not paid it yet, that unpaid bill is also a liability. If the bakery buys flour and sugar from a supplier on credit, the amount owed to the supplier is called accounts payable, and that is also a liability. So assets show what the business has. Liabilities show what the business owes. Now let's look at the third part, equity. Equity is the owner's claim on the business after liabilities are deducted from assets. In plain language, equity is what belongs to the owner. Think of it this way: if a business has $10,000 in assets and owes $4,000 in liabilities, the owner's equity is $6,000. Why? Because if the business used its assets to pay everything it owed, the remaining amount would belong to the owner. So we can also think of equity this way: equity equals assets minus liabilities. But the main accounting equation is written as assets equals liabilities plus equity. Now let's ask an important question. Why must this equation always balance? Why can the left side never be higher or lower than the right side? The answer is simple but powerful. Every asset must have a source. If a business has $15,000 in assets, those assets did not appear from nowhere. They had to come from somewhere. There are only two broad sources. The business may have received resources from creditors. That creates liabilities. Or the business may have received resources from the owner or from profits generated by the business. That creates equity. So the left side of the equation shows what the business has. The right side shows where those resources came from. Let me say that again because this is the heart of the accounting equation. Assets show what the business has. Liabilities and equity show how those assets were financed. That is why assets equals liabilities plus equity. Now let's ask an important question. Why must this equation always balance? Why can the left side never be higher or lower than the right side? The answer is simple but powerful. Every asset must have a source. If a business has $15,000 in assets, those assets did not appear from nowhere. They had to come from somewhere. There are only two broad sources. The business may have received resources from creditors. That creates liabilities. Or the business may have received resources from the owner or from profits generated by the business. That creates equity. So the left side of the equation shows what the business has. The right side shows where those resources came from. Let me say that again because this is the heart of the accounting equation. Assets show what the business has. Liabilities and equity show how those assets were financed. That is why assets equals liabilities plus equity. Transaction 2. Amma buys bakery equipment for $4,000 cash. What happens? The business receives equipment. Equipment is an asset, so equipment increases by $4,000. But Amma paid cash. Cash is also an asset, so cash decreases by $4,000. This is important. The business did not create a liability. The owner did not add more equity. The business simply exchanged one asset for another asset. Before the purchase, the business had $10,000 cash. After the purchase, the business has $6,000 cash and $4,000 equipment. Total assets are still $10,000. Liabilities are still $0. Equity is still $10,000. The equation still balances. Transaction 3. Amma buys supplies for $1,000 cash. Again, one asset increases and another asset decreases. Supplies increase by $1,000. Cash decreases by $1,000. Now the business has cash, $5,000. Equipment, $4,000. Supplies, $1,000. Total assets, $10,000. Liabilities, 0. Equity, $10,000. The equation still balances. Transaction 4. Amma borrows $5,000 from the bank. What happens? The bank deposits $5,000 cash into the business account. Cash increases by $5,000. Cash is an asset. But the business now owes the bank $5,000. That is a liability. So assets increase by $5,000 and liabilities increase by $5,000. Now the business has cash, $10,000, equipment, $4,000, supplies, $1,000, total assets, $15,000, liabilities, $5,000, equity, $10,000. So the equation is $15,000 equals $5,000 plus $10,000, still balanced. This is the power of the accounting equation. Every transaction affects the equation, but the equation must always remain in balance. Now let's bring in business operations. So far, we have looked at owner investment, buying assets, and borrowing money. But a business also earns revenue, pays expenses, and may distribute money back to the owner. All of these affect equity. That is why we often expand the accounting equation. The basic equation is assets equals liabilities plus equity. But equity can be broken down further. For a small business like Amma's Bakery, equity includes owner's capital plus revenue minus expenses minus owner withdrawals. So we can write the expanded equation this way. Assets equals liabilities plus owner's capital plus revenue minus expenses minus withdrawals. If we are talking about a corporation, we usually use the word dividends instead of withdrawals. So for a corporation, the expanded equation can be shown as assets equals liabilities plus contributed capital plus revenue minus expenses minus dividends. Now let's make this practical. When Amma invests money into the business, owner's capital increases. That increases equity. When Amma earns revenue from selling bread and cakes, revenue increases. That also increases equity. When Amma pays expenses like rent, wages, or utilities, expenses increase. Expenses reduce equity. And if Amma takes money out of the business for personal use, withdrawals increase. Withdrawals also reduce equity. For corporations, when dividends are paid to shareholders, dividends reduce equity. So the key idea is this: owner investment increases equity. Revenue increases equity. Expenses decrease equity. Withdrawals or dividends decrease equity. The equation still balances because every transaction affects both sides, or it changes items within one side without breaking the balance. Let's apply that to Amma's Bakery. Suppose Amma sells bread and cakes for $2,000 cash. Cash increases by $2,000. Cash is an asset. At the same time, revenue increases by $2,000. Because revenue increases equity, both sides of the equation remain balanced. Now suppose Amma pays $500 cash for rent. Cash decreases by $500. Cash is an asset, so assets decrease. Rent expense increases by $500. Because expenses reduce equity, equity decreases. Again, the equation remains balanced. Now suppose Amma withdraws $300 cash from the business for personal use. Cash decreases by $300. And because withdrawals reduce the owner's claim on the business, equity also decreases by $300. If this were a corporation and the company paid dividends to shareholders, the effect would be similar. Assets decrease and equity decreases. This is why revenue, expenses, withdrawals, and dividends are not separate from the accounting equation. They are part of the way equity changes over time. Now let's pause and summarize the transaction logic. If the owner invests money, assets increase, equity increases. If the business borrows money, assets increase, liabilities increase. If the business buys equipment with cash, one asset increases, another asset decreases. If the business earns revenue, assets increase, equity increases. If the business pays an expense, assets decrease, equity decreases. If the owner withdraws money or a corporation pays dividends, assets decrease, equity decreases. The equation must always balance. Here's the mistake many students make. They memorize the formula, but do not understand the story behind it. Do not just memorize. Assets equals liabilities plus equity. Understand what it means. The business has resources. Those resources were financed either by creditors or by owners. Creditors create liabilities. Owners create equity. Revenue increases equity. Expenses decrease equity. Withdrawals and dividends decrease equity. So the accounting equation is not just a formula. It is the financial story of the business. Let's close with a simple way to remember it. Assets tell us what the business has. Liabilities tell us what the business owes. Equity tells us what belongs to the owner. And equity changes through owner investment, revenue, expenses, withdrawals, and dividends. Together, these ideas bring us back to the foundation. Assets equals liabilities plus equity. That is the foundation of accounting. Thank you for watching Accounting with Professor Lamptey. If this lesson gave you clarity, please like this video, subscribe to the channel, and hit the notification bell so you do not miss future lessons. Also, drop a comment below. Which part of the accounting equation is most confusing to you? Assets, liabilities, or equity? I read your questions, and they help me decide what to explain next. Until next time, remember, accounting becomes easier when you understand the story behind the numbers. See you in the next class.